If you're watching this, I'm gonna guess you're the type of person who does not want to work themselves into the grave. And that's why I'm really glad you're here, because I've just conducted an extensive piece of research to find out what the most consistent income strategies are on the Australian share market. My name is Vishal Teckchandani. I'm a senior editor here at Livewire Markets, and in this video, I'm gonna reveal the top 10 Australian and global equity ETFs and LICs over the past 5 years. Now, as many of us know, when it comes to income investing, consistency is the key, and consistency is what we want. It probably does you no good if you're planning for your retirement or aspiring to a FIRE lifestyle to have investments which are maybe paying 8% one year, 2% the next, or have a checkered history of dividend payments. That's why I've worked on a methodology that aims to strike a balance between achieving good dividends, healthy capital growth, and what you can do is head to the description below, click on the article that I've published on livewiremarkets.com relating to this video, where you can understand and read the methodology in detail, peruse through the information and performance tables at your own leisure, and access the many wonderful insights and interviews that we have with the fund managers and ETF issuers that we're going to talk about today. Okay, so let's kick off with the Australian income champions, and you're going to see the top 10 list on the screen here. And I'm going to read out the gold, silver, and bronze and talk about some of the themes on this list and why some of these managers and strategies performed as well as they did. So the gold goes to the VanEck Australian Banks ETF, returning more than 20% per year with total income growth of 140% over the 5-year period. Hot on its heels is the Spider S&P ASX 200 Financials A-REIT ETF with 19.35% per year. And the bronze goes to the Spheria Emerging Companies Strategy, a listed investment company which has done over 17% per year and has a gross yield of north of 8%. Now, when we look at this table, there's a couple of themes stand out. The first is that the banks in Australia have had a sizzling run over the past 5 years, and that's why MBB and OZF are at the top of the list. But some of these broad market and broad dividend strategies, like the one from Beta Shares, the Vanguard High Yield ETF, and Russell, they've performed so well because of the banks. Now, I want you to remember back to 5 years ago in July, when Australian banks were on their knees, okay? This sector was completely beaten down. CBA, NAB, ANZ, etc. They were under a lot of pressure. I think NAB's share price came down below $20. They did a capital raising. The dividends were cut. Now, what happened over the ensuing 5 years? Of course, we recovered from the pandemic. We had the interest rate shock, which was good for bank margins. And then interest rates also fell, which are also good for demand in terms of home loans. So what we've really seen here is a normalization of bank share prices and a normalization of dividends. So I just want to be quite considered here with what's happening with the banks. It's not like they're spitting out money and increasing their dividends left, right, and center. It has really been a normalization story where the sector was under a lot of pressure and things just normalized. Nonetheless, Australian banks are and always will be income machines for any income investor's portfolio. If you think about it, it really is a monopoly market. You've got CBA, ANZ, NAB, Westpac, Macquarie as well, and they really just dominate the space in terms of home loans and other types of financing. And what the Australian market has is very strong immigration. So you have new entrants to the country all the time, and you have existing consumers like yourself and me who always need more loans, whether that's to buy a property, investment property, a new car, a personal loan, a margin loan, perhaps for equity investing. People, once they get into a bank, they tend to need multiple loans throughout their life. And thanks to government policy, they have a almost unending source of income because of immigration. So that's why banks are always going to be attractive in terms of income, but the valuation at different stages of the market is always a question, of course. I just want to touch on Spheria quickly. So this is a really interesting listed investment company. Why have they outperformed? Number one, they operate in the small and mid-cap space, and they've picked some real winners, companies like Technology One and Supply Networks Limited. They've gone gangbusters over the last couple of years. But what Spheria has done is also really interesting in the LIC space, where a couple of years ago, they adopted a very income shareholder friendly policy where they moved to a quarterly dividend schedule, and they're paying out 1% of their post-tax net tangible assets. So what that gives income investors is predictability. It gives them regular cash flow, and I think that's really helped support Spheria's performance. And the last theme I want to touch on when it comes to the most consistent funds for Australian equity income is the Vanguard Australian Property Securities ETF. This strategy has delivered quietly returns of above 10% over the last 5 years. It's got a dividend yield of 4% plus. And what's happened is we've seen some tailwinds and some normalization activity within the A-REIT space as well. So we all thought office towers were dead, nobody would return to the office. That's certainly not been the case. The train stations are full, the bus stops are full. People are going back to the city to work. And that's been a boon for the owners of office buildings, which are these A-REITs. So these A-REITs are making a lot of money from their office tenants. There's also some sub-themes to take a note of in the A-REIT space. So things like storage units, fulfillment centers for e-commerce and Amazon so that we can get our goods delivered quickly, and of course the data center boom, which is an integral part of the gold rush we're seeing in terms of artificial intelligence growth. So I think, A-REITs have lost some of their shine, but investors may want to take a look at this space again because it's got very attractive tailwinds from an income perspective. Okay, so let's move on to global equities. I'm going to put the top 10 list on your screen here, and I'm going to read out the gold, silver, and bronze. All three of them are listed investment companies, which are really interesting. So the gold goes to the PM Capital Global Opportunities Fund with a return of nearly 30% per year and 120% increase in dividends over that 5-year period. The silver goes to the L1 Long Short Fund, which did nearly 22% per year. And the bronze goes to the Stored Capital Global Value Fund, which is up 14.28% per annum. So all three of these are listed investment companies. And so I've done my research and I looked at the commonalities between some of them. And so what's happened here in terms of helping their performance is that these strategies have what we call very flexible investing mandates, where they're not tethered to the index and have to hold companies slightly overweight or slightly underweight in reference to the index. They can basically do whatever they want. They can go to any part of the global equity universe. They can go long, they can go short, they can be completely not invested in a sector. So in PM Capital's case, this year, they've made some very interesting moves and bets which have paid off. They've rotated into European banks. As we know, there's been some questioning of US exceptionalism, and we've seen the European market roar back to life. And so European banks have done really well. They've rotated into American banks, industrial metals, and they also shorted the NASDAQ futures when tech stocks were tanking earlier this year. So that's really paid off. And so when you have a global mandate, a flexible global mandate, and you make the right calls, it can produce some very, very chunky returns. The other thing for PM Capital is that, again, they're quite friendly in terms of setting expectations with income investors. So they announce every year what level of income investors can expect in financial year 25. I believe it was 11 cents for the full year. And so having those policies are very conducive to attracting income investors to these listed investment companies. And lastly, some of these dividend-focused ETFs have delivered some very, very attractive income returns. If you look at the Global X S&P 500 High Yield Low Volatility ETF, the SPDR S&P Global Dividend ETF, and the BetaShares Global Income Leader Strategy, they've all delivered some fantastic income growth, and they have yields of around 3 to 5% depending on the strategy. And what's interesting about international markets is that while the starting yields do tend to be lower than what Australian companies tend to pay, their payout ratios are also lower. So they do tend to increase their dividends quite steadily over time. So from a diversification perspective, these strategies could be worth looking at if you want to build a resilient income portfolio. So when we look back at the data, what are some of the key lessons we can learn? Now for me, there are three. The first is that you should look at the whole investment universe broadly, whether it's an LIC or whether it's an ETF. I know a lot of people have some angst over active managers, but as the data has shown, some of these active managers are delivering fantastic returns, they're providing quarterly distributions, so it's more so that you want to understand the methodology, the process, the income payment policy, and use the best to your advantage. The second is that income shouldn't come at the expense of capital growth, and that's why in my methodology I was so careful to avoid potential dividend traps that are paying 10% dividends in 1 year, but then they bleed out their capital on the other side, or they've just got very, very messy dividend histories, which make it impossible for you to plan how much income you're going to get from one period to the next. And lastly, when looking at any income investment, really important to look at the dividend growth track record of the strategy, ETF, LIC, or any individual stock. In the same way as when we work or when we run a business, we expect higher profits or pay rises. You want to make sure you're investing with good stewards of capital or strategies that have a good methodology where the income is going to be higher over time. That's it from me. My name is Vishal Teckchandani. Again, I hope you enjoyed this episode and I hope you got a lot out of these ideas. Just a quick disclaimer again, these are not recommendations. These are simply investment ideas and they're based on past performance. So please look at any of these on their own merits in detail, do your own research, speak to a financial advisor before making any investment decisions. Have a great day.